Hello, everyone. My name is Tatiana Kleiman. I'm a board member at Impact Capital Forum, and I'm delighted to welcome you to today's event, Understanding How the American Rescue Plan Can Turbocharge Opportunity Zone-Based Investing. For those of you who are new to Impact Capital Forum, we're an individual member organization with the mission to advance the social finance sector by providing a platform for collaboration, innovation, and thought leadership. We host events throughout the year on the most urgent topics for impact investors, social entrepreneurs, asset managers, and the broader community of impact-oriented professionals. Our next event will focus on innovating financing tools that drive clean energy in LMI communities. We also host working groups that give our members the opportunity for deeper engagement with specific topics, such as opportunity zones and gender lens investing. Today, it is my pleasure to introduce the moderator of this panel, Kenneth Allen. Ken has over 25 years of experience in investment banking, business strategy, and project management, and is the founder of Azurest Partners, a financial advisory firm. He's also a fellow board member at Impact Capital Forum. Ken, I'll turn it over to you to introduce the rest of our panel.
Great. Thank you very much, Tatiana, and hello, everyone. My name is Kenneth Allen, as Tatiana mentioned. I'm a recent addition to the board of directors for Impact Capital Forum, but have been around and familiar with the ICF's work for the last couple of years. It's truly a center for thought leadership and networking for people who care about a range of topics related to things around sustainability, microfinance, which was the original name of the organization, as well as social impact investing. One of the main areas of endeavor for the Impact Capital Forum happens to be Opportunity Zones, which is one of the working groups that the Impact Capital Forum sponsors. So there's an ongoing dialogue around that particular topic. And so we're delighted to have two really knowledgeable professionals who understand opportunity zones and can discuss with everyone on the webinar the impact of recently passed legislation, which will hopefully turbocharge investing for America's infrastructure and for getting the country to the next level. So with that, let me take a few moments and just introduce our two speakers. The first is Beau Kemp, who is the Chief Executive Officer of the Southland Development Authority. At Southland, Beau partners with a national network of policy leaders and business executives to help drive growth, tackle major initiatives, and boost efficiency for municipalities. Beau is highly experienced in structuring and in the execution of public-private partnerships and has a reputation for driving innovation for municipal utilities, public infrastructure, and economic development for legacy cities. Joining Beau is Charles Sheffield, who is the Managing Director of Capital Access, where he helps the firm's clients take principal investments across a variety of industries. He was the Managing Director of Clearbrook Global Advisors and Snowden Lane Advisors, where he advised clients regarding their own private investments. Prior to this, Charles was a founder and partner of Carthage Capital, where he made investments primarily in supply chain software companies. And if that's not enough, Charles also worked at Accenture and at Mitchell Titus, the accounting firm. So with that, I'm going to turn the webinar over to our two speakers. I think we're going to start with Beau. Beau, I invite you to add any additional details about your background, share your slides, and help everybody understand how the American Rescue Plan is going to help America's cities.
Let me interject, if you don't mind. Thank you for that introduction. But since Beau really is the expert and I'm sort of the wingman, let me just frame why I'm relevant. Okay. First off, I've known Beau for, I don't know, 30 years plus, and he's probably the most unique guy that I know in terms of having experience in private equity, venture capital, media, running media companies, buying media companies, doing things in the government, working with running Newark, which is where Cory Booker was the mayor. But more importantly, I look at Beau as a person that we want to invest in because of his expertise around this matter. And my focus is making general partner investments in alternative asset managers. And so the reason I'm motivated by what Beau talks about is that he has a very specific way of approaching this marketplace. And we want to be investors in him, and that's why I'm involved. So my background has been, making investments in lots of different companies, but our focus now is investing in opportunity zone general partner managers. So that's why I'm here. So I'll turn it over to Beau from here.
Thank you for that, Charles and Ken and Tatiana. I'm excited to be here. And Charles and I are going to take you through this presentation. I'll be a primary lead, and Charles will will come in, and as we've worked together, as he mentioned, for 30 plus years on things, we have a good partnership in how we give these sorts of presentations. I've started the presentation with the basic assumption that I've got a fairly sophisticated group of people on the line. And so I'm going to go through a lot of it quickly in order to allow for time for questions, especially since you've got a working group around opportunity zones. Just a small commercial on top of everything that Kenneth and Charles have already said. Part of the reason that I was invited is because of the work I've done specifically around opportunity zones. Since the passage of the legislation in December of 2017, I've been engaged directly both with the federal government and then directly in actually executing transactions since that time period. That was in large part because, as was already alluded to, I worked directly for Cory Booker, where I ran the city of Newark when he was just originally elected as mayor. And so when he became a senator, he was a co-sponsor of the Opportunity Zone legislation along with Tim Scott. And so I was an early adopter of this process. And in that process, at the time, I was working with a very large law firm, billion-dollar law firm. I ran our Opportunity Zone strategies within the law firm for all of the various departments. And so that meant that I was engaged with our team that was doing OZ fund formation. So that's the team that would typically work with asset managers, hedge funds, and other investment entities. I also worked directly with our wealth management team, who was actually looking at using opportunity zones as one of the strategies for wealth management investments. That also meant that I worked with our corporate team, who was looking at corporations that were either looking to move their headquarters or to make new investments and to leverage opportunity zones as a tax strategy. And I also worked directly with municipalities. And in doing so, I've represented multiple municipalities around the country and helping them develop their strategy for attracting private capital to coincide with their public investment around opportunity zones. And that includes Hillsborough County, Florida, and the city of Tampa, where for the last 2 years, we've been working on a large-scale development, which I'm going to share with you at the end of this presentation so that you can get a sense of how you can create, in this instance, a 19 square mile space that has multiple opportunity zone projects that go from operating to real estate and also target different industries, to give you a sense of how to think about that. I've also worked directly with the city of New Orleans and Orleans Parish, as well as the 10 parishes that all represent Southeast Louisiana for the last couple of years. And that means working with rural parishes like Tangipahoa, which borders Mississippi, where they're looking at opportunity zones to leverage things like, how do I deal with manufacturing? How do I deal with agriculture? How do I think about this in a rural context? But also suburban entities like Jefferson Parish, which is outside of New Orleans. How do I think about this in the context of a suburban market, as well as in the inner city in Orleans itself, in the 7th Ward, the 9th Ward, and New Orleans East? And so my experience set kind of spans a pretty broad cross-section of all the various types of transactions and various types of topology where you can make investments in the opportunity zone. And I've been a thought leader and written a bunch of pages and papers and so forth. I've gone out and worked with each of the large federal agencies that are responsible for overseeing the opportunity zone structure over the course of the last 2 years, speaking at about 50 different locations and writing about a dozen or so papers, both internationally and nationally. I'll mention the international part because it may be relevant to some of you. I've written a couple of articles in the UK and done some work with investors that are in Latin America and Asia, where there's a strong interest in leveraging opportunity zones for their portfolio as well. There may be some questions related to that come up in the presentation. So on from the presentation, is this the end times? And what is going on in the world? And at times it does feel like the end times. But the short synopsis that all of you should be aware of is what's happened under COVID and its impact on small businesses in particular has been dramatic. The health crisis has transitioned to a liquidity crisis that has become a little less of a crisis in terms of the liquidity side. But as you all will remember, early last year in March, April, and May, there was no debt to be had working with any bank. and that resulted in a solvency crisis. Now we're still seeing the impact of the solvency crisis across the board. The other businesses are responding differently, but that solvency crisis was disproportionately felt across the spectrum. Obviously, a lot of commercial real estate and in some cases, industrial real estate has been impacted by that process. A number of small businesses, particularly those that are focused in the hospitality industry, have suffered. Over 50% of the jobs that were lost in this period were in the hospitality space. There have been efforts at the federal level and some efforts at the regional and local level to try to address these issues, but they're still in many cases in their infancy. They're very nascent in their process of actually figuring out how to respond completely to the issues of the businesses that have been negatively impacted. And there's going to be a substantial need for us to try to address these issues. Some of the legislation that has come out, and I'm going to talk a little bit about the Coronavirus Relief Fund, CRF, which was passed in 2020, as well as the American Rescue Plan, ARP, which was passed this year, and how those funds could be used. But there are also opportunities for you as investors to think about how to leverage these funds in a way to address investment opportunities broadly and specifically issues that might be related to Opportunity Zone and the impact of COVID. Lastly, the lockdown that we experienced, particularly for hospitality, but businesses across the board, have meant that there's been a lot of change in the way that people even think about how they operate on a going forward basis. And in that change comes some risk, but also some opportunities. In terms of where we are in terms of stages, we have been for a very long period in this kind of stage that's outlined in the red box. You know, with the immediate health crisis, we've had fits and starts of how to respond to the health crisis. There's been this effort around employment triage, which has been inconsistent depending on both industry and depending on the region of the country. There have been some efforts around a local stimulus plan, but much of that was really driven by what was happening at the federal level. And the federal level was driving recovery plans on the basis first of CRF, which is the Coronavirus Relief Fund, and now recently around the American Rescue Plan. Most individual cities and regions have yet to fully realize the positive impact of the monies that have been invested by CRF and the monies that are to be invested by ARP. But there is an opportunity in this process to help influence public investment in a way that can also support, reduce your risk as a private investor, and together actually have the kind of social impact that is intended by the Opportunity Zone legislation and frankly needed given what's happened with the pandemic and the economic decline. One thing I just want to make clear that people understand is you've heard people talk about a K-shaped recovery, and that idea really stems from the idea that there's going to be an uneven and unequal recovery, just as there's been an uneven and unequal impact of COVID on individual businesses. For many of us who are in white-collar businesses, we've actually been able to, in many respects, not only maintain a large part of our revenue drop from 2019 to 2020, but also reduce our expenses in a way that actually our net bottom lines have come out similar to where we anticipated at the beginning of the year, or in some cases even better. That's not true broadly for municipalities. That's not been true for a lot of sectors of the economy. And what this chart here shows you, some of the work that I've done and I do broadly around the country with Michael Pagano in particular, which is really evaluating the impact on cities. It shows you kind of the three sources of income that are generated by cities, and it gives you a glimpse of how those different sources of income fluctuated during previous recessions, right? So 1992, 2000, 2008, and now going into 2020. A couple of things that you'll see is sales tax obviously will drop and has a larger alpha, greater variation, right, than almost all of the other forms of tax. It's totally dependent on the money that's been spent. There's been a lot of effort with the Coronavirus Relief Fund and the American Rescue Plan to put stimulus money into people's pockets. And that, I think, will actually come around and be helpful in the long run. But The drop that you see that took place, which is this dotted line for 2020, was much steeper than what you saw that happened, the drop that took place with the Great Recession, and obviously the drop that happened in 2000 after the internet crash. And what's important to recognize about that is it took almost 12 years for cities to recover financially from the drop that took place in the Great Recession, which meant most of those cities were only recovering completely their forms of revenue just as we entered into this economic recession that just took place. And different cities are responding in terms of their sales tax, income tax, and property tax very differently. You'll see here also the income tax has dropped off significantly in this recession. Property tax a lot less so. Meaning we're seeing this odd dynamic now where people have found the capacity to buy a lot of housing. And so housing prices are actually going up because supply has been curtailed because there's not been the workers in order to actually do a lot of the construction. So there's some weird dynamics that are going on, but it just should be noted that the drop off in income tax and the drop off in sales tax was pretty steep, much steeper than it had been in previous recessions. And it took 12 years last time for those things to recover. What that speaks to is that there's going to be a deep hunger for a lot of cities to figure out how to be really smart to encourage additional development, because that's the way for them to reduce the time frame to recover from 12 years to 10 years to 8 years or whatever it may be. So it becomes a prime opportunity for smart investors to think about how I partner with the public sector in order to reduce my risk, to address some of the capital stack issues for the type of development that I want to do. And there's some thought to be given as to what industries and sectors you want to be in. And we'll get into that a little bit more later on. There's a new normal that cities are also preparing for. There's a globalization in retreat issue, which for certain parts of the country actually bodes very well. I do a lot of work in the Midwest, which is a manufacturing and a making place. And in those instances, a lot of the work that had previously been done overseas or in other parts of North America are starting to matriculate back, to the Midwest, not only because there's a need to deal with it as a result of COVID, but a national security interest. And there's obviously an infrastructure and a talent pool that's already established to actually take some of this work back. But there's a trend there where people are looking for opportunities. So if you are looking at investments that may have a positive social impact that are in the industrial space, there's a lot of opportunity to have a direct conversation with public entities about how to do that, and they're eager to have that conversation. There's also an obvious one that's related to the hospitality issue, which is travel patterns are shifting, much like what happened after 9/11, where much of the work of the travel that people used to take for vacation, instead of going overseas, started to be internal. The same is happening now. So you'll have places like New Orleans or Tampa, just to name a few, that are starting to pick up in terms of activity. But what's funny and what's happening is, because so much of the job losses were in the hospitality industry, and the people who work in the hospitality industry have a specific skill set, many of them were forced to actually leave those locations, which is a lot of what you saw happening in New York City itself, and take jobs in other industries. So as now these industries are coming back online, and as many of you probably heard, July 1st, the mayor of New York has announced that all the restaurants are going to be open. One of the things you're starting to see in other parts of the country that are already open is they're actually having difficulty staffing back up. And they're struggling with that because the people who previously had been in that industry had moved away. They now can't bring them back, and they can't fully staff. I only mention this because, again, as you start thinking about impact that you can have, the types of investments that will solidify and keep those bases of working people who have that specific skill set, particularly in places that are high on hospitality, Nashville, those types of places that are really dependent on convention traffic. That's going to be an important driver. And it's also another reason for the public sector to co-invest with you as a private investor in certain areas. There's obviously a new normal with regards to personal interaction, food safety, client safety, and the like. And all of this really leads to the last points, which is public money in the course of the last year has been much more of a driver than private money has been, particularly in real estate investment, but potentially also in some operating investments, which is a kind of a new play on things. And municipalities are starting to rethink how they should be making certain investments. So pre-development investments, things like, should I put in this broadband? Should I put in this new road? Not only are they thinking about that differently to spur private investment, but now that they've got money from both the Coronavirus Relief Fund, CRF, and the American Rescue Plan, they have more money than they've had in our lifetimes to actually make these kinds of pre-development investments. So if you're trying to make an impact investment and leverage opportunity zones today, there's an opportunity for you to engage the public sector very smartly and very differently than there's ever been in our lifetime. So there are several federal public funding sources. This is not an exhaustive list, but this is probably the most critical list that kind of lays out for most investors where you might be able to leverage some private funds at the federal level. And I will talk about the local level a little bit, and I'll give you some examples. So for those who are interested in making investments in the housing space, there is a substantial amount of money that's gone into housing and urban development. A lot of that has gone through the CDBG funds. Those funds are actually being used in a variety of ways at the local level, not just for housing, but for a lot of different places. To give you a tangible example of somewhere where I have some familiarity, in just the Cook County, which is the third largest county in the United States, represents Chicago, there's an additional $77 million for housing that's been allocated to Cook County related to residential housing right now. And most cities struggle on how to develop affordable workforce related housing anyway, and don't actually even spend all of the money that they have in that area because it's difficult to create the proper capital stack and get the private investors. But if there was ever a time for those who are in that space to take advantage, this is that time to do so, because they've got capital funds and they need to spend that money. Now I'm going to divert for a second on this chart that I'm here, just to talk a little bit about the CRF funding, the coronavirus relief funding. When that money was approved in 2020, that money actually started to trickle into municipalities roughly by about June of last year, June or July of last year. And they were required at that time to spend the money by December 31st of last year. And so most cities rushed to try to figure that out, and most cities were highly unsuccessful. The federal government extended the time frame for the coronavirus relief funding to not have to end in 2020 of December, but through December 31st of this year. So every municipality of at least 500,000 people in size, every county and all the states have additional funding that they received in 2020 for all of these different public funding sources that I described in one form or another. That's available now. Much of it was spent, but not all of it has been spent. And many of them are now in the process of thinking, how do they execute and spend that money through the end of this calendar year? So for those who are interested in pursuing opportunity zone investments and want to leverage that public funding source, there is money available. Now, every individual location will be different in terms of, how efficacious they were in spending the money. Some did a really good job. Some have had to struggled because they haven't been able to find the right projects. But I would highly encourage you to think through and actually ask those questions. Now, in addition to the CRF money, which is available right now, we got the ARP, the American Rescue Plan, passed, and that money is scheduled to actually go out in the second half of this year. My previous firm, we did a lot of work on the federal level, believes that the regulatory guidelines for that money are due by May 10th, so the week after next. And with those regulatory guidelines, it will determine the ways in which cities and counties can spend that money. But the reason I'm focusing on this so much is the breadth of the legislation is so wide that there are a lot of things you could do. For example, the cities are now in a place where they could actually give a grant of $1 million, if they so chose, to an individual company as part of their economic recovery for that business, right? So if you can make a solid case as to why the social impact of this business is so great that the municipality should participate in a structured and direct way, they actually have the flexibility to do that right now. And that's never happened. And so that's a very different place, especially if you're trying to figure out your capital stack, how you're going to develop, and if you're bringing private capital to the table that can be supplemented by private public capital. It's a different kind of conversation that exists today that probably will not exist in the future and definitely has not existed in the past. And so I just want to highlight your mind to that as a possibility. Much of the money and the conversation has been around the funding that's gone to the Small Business Administration, which has been around the Paycheck Protection Plan, which is outstanding right now. It technically closes May 17th of this year. It's quite possible that they will extend that through the end of the year. There's also possible that they may have run through all of the money. It's uncertain. There's been a greater focus on very small businesses. But again, if you are an opportunity zone investor who's making investments in operating businesses, this is a great opportunity for you to take advantage of the Paycheck Protection Plan as a supplement to some of the pain and suffering that operating business may have already experienced. The limit is up to $2 million, so you can't get more than $2 million. But as opposed to round one of PPP, which was part of the CRF funding in 2020, where you could get a larger dollar amount, but there were a lot more restrictions on how you use the money, requirements in terms of reporting that were somewhat onerous, that made people not want to take the money in the first place. There are no requirements for repayment for the second round PPP that we're currently in. You get less money, but there's less regulatory guidelines to have to meet in order to qualify, and there's less issue with regards to the repayment. So again, for those who are focused on the operating investment side, there's an opportunity here. I'd say likewise with the economic injury disaster loans or EIDL loans, also the SBA 7A loans. Both of those also got additional funding from CRF. They're going to receive additional funding also from ARP, and they both serve as another source of funding for operating businesses for you to consider as a complement to your opportunity zone equity investments. EDA has actually gotten more money than they've ever received probably in the last 30 years combined. So between construction grants, revolving loan funds, what they call capacity building grants and planning grants, there is a lot of money that EDA has available right now that they haven't in the past. What's important to know about EDA, and I don't say this in any negative way about them, but they've been one of the agencies that have had difficulty in actually getting their money out the door. So there's more likelihood that there's an opportunity to take a project. If you were going to build, for example, a mixed-use housing project that had retail, had a market rate and affordable housing all in one complex, you actually, in the process of looking at all these agencies, could get construction grant money from EDA, you could get money from SBA for the support of your operating businesses, and you could get some support money from HUD all together in addition to your opportunity zone funding, a new market tax credit, or historical tax credit, given whatever the composition is of your transaction. So I really just want to highlight the fact that you can take all of these programs and fund them together. And if you can make a coherent argument for a lot of municipalities who are very sensitive right now to not only the issues of how do I keep my people employed, how do I develop something that has and feels that it has an appropriate social impact that's consistent with the opportunity zones laws, but also how do I do something that feels like it's driven by equity, social equity in my markets. There's a lot of reason for cities to take a risk to do something today that they would not have done in the past. So I'm going to go through a real quick overview of opportunity zones, just in case we've got people who are not familiar, but it's going to be lightning fast. And I'm going to focus on the back end on more things around structure and things that I think might be more interesting given that this is a sophisticated crowd. So again, high level real quick, created in December of 2017 with the passage of the budget, 25% of all census tracts were approved. It should be noted because the 2020 census is complete. The new census tracts that have changed as a result of the previous census tracts do not change the location of opportunity zones. That can only be changed by a direct act of Congress, which has not happened as of yet. So the 8,764 zones that were located across the country and defined in 2018 are the exact same zones today, despite any changes to the census, right? So it's a point that always comes up. It's important to note. I think one thing that's surprising to people is people think opportunity zones, and I think a lot of people naturally think it's just in the cities. I made the point to you about the work I do in Southeast Louisiana because a third, or roughly 40% of the zones are in urban, rural areas, and that includes tribal lands, which we've done work with, as well as just general urban areas. 40% are in urban areas, and 30% are in suburbs. So it's actually fairly distributed across the country. And where it is in those rural populations, it's usually huge tracts. So like I've done work with chicken farmers in Arizona and, cow ranchers in Arizona that have, literally 1,000 acres of land that's in Navajo country that all sits within an opportunity zone. And they're looking at ways to find ways to diversify their income for their ranch work, as an example. There are 3 benefits to the opportunity zones. There's the tax deferral, the tax reduction, and the tax exclusion. And part of the slowness of getting started around opportunity zones is that it took a couple of years to really get all the final regulatory guidelines established. The reason that a lot of that work was done, a lot of transactions have been done on the real estate side, is because the real estate guidelines were set faster than the operating guidelines, but we're moving into a different place, and I'm going to talk about that a little bit later. I'm not going to go through this page in large measure, but there are 3 benefits: the tax deferral, the timing of when you pay your existing tax, a reduction in step up, which is based on being able to complete a transaction by the end of this year, and tax exclusion, which is the biggest one, which if you stay invested for 10 years, you can permanently exclude any gains on your new investment. And that's really the Shangri-La that everybody is focused on. There are reasons why people will have a different focus on different components. But just to be clear, until the Congress changes any of the specific legislation for opportunity zones, you'll still be able to make that investment and get the 10-year benefit, but the tax reduction portion will only be allowed for those investments that are completed by December 31st of this year. They've made some adjustments in terms of timing of when you can claim tax gains to actually be invested in opportunity zones, but they've not changed yet the time frame for the tax reduction or the end of the program itself. And I'm going to speak to the timing and the renewal of the program at a later date. The OZ system in this page is even outdated from when I originally made this, which is a couple of months ago. There are many different other players in the OZ ecosystem. Real estate funds have been large, and there have been many. There have been a number of banks like Goldman Sachs and PNC, but that's not to the exclusion of others. There are a lot of sector-focused funds, so funds that are focused just on defense, just on esports, or just on solar or vertical farming. There are many social impact funds, and you guys represent a lot of those. Family offices, as well as philanthropic and OZ resources, and I've had the chance to work with both Rockefeller and Kauffman foundations on work that we're doing in some of the areas. And a number of cities have been really intentional about thinking about which specific projects, concept areas, and forms of incentive they can provide to attract private capital to invest in those projects and concept areas and be coupled with public investments. I've mentioned to you some of my clients. I'm actually going to be doing new work for the city of Tampa around a prospectus, but Norfolk, Virginia has done a lot. Birmingham, Alabama is one of the leaders, along with Erie, Pennsylvania, as well as Louisville, Kentucky, just to name a few, but there are many at this stage. I won't go through this continuum because you guys are on the social impacts, so you get it. But the point being is that, there's this continuum of where people are. Many of the folks who were kind of in the more traditional investing have started to move closer to responsible investing. And likewise, those responsible have moved more towards social impact investing, especially given the events that have happened over the course of the several years. One of the issues that we talk about when we deal with municipalities often is this issue of social equity and risk of displacement. Risk of displacement often gets used is a I think, a better term than the shorthand term, which is gentrification. Gentrification is what people normally are talking about, but theoretically, I mean, by the definition of gentrification, we all want to live in a better neighborhood, which is what gentrification means, right? But what people really mean is displacement. And they mean displacement not only of people, but also of businesses. And that's a real issue. So you, as a social impact investor, one of the things that I do when I work with municipalities is we try to rate the risk of displacement of people and of businesses and create mitigation strategies that are specific to businesses and to peoples in the areas where we're looking to attract that private investment. And I would only encourage you to start at that same place. And that's the nature of a lot of the type of work you do anyway. But start at that place for cities because they need help in this regard. And it's a critical and important issue. You know, much of the kind of incentive work that I would encourage you to pursue is what I'll call off balance sheet work. It's not typically asking for the tax abatement or the TIF, the tax increment financing, that often you'll get when you're doing a large scale, for example, real estate development, because those are all controversial. Even when they're warranted, it takes a lot of public work to communicate to the council that have to vote and all the various committees and the public generally about what the benefit of this is. There's a lot of things that you can ask for that I call off balance sheet that are less controversial, but have equally, and in some cases, greater impact on your mitigation of risk and cost to you as a developer or for your investment. But the way to frame it is in the context of risk of displacement, and to do it in such a way that you can demonstrate how this kind of investment, you can leverage it in order to mitigate the types of issues that might cause the displacement. You know, one of the things that's also been important, particularly in this context, is really assessing where social equity stands in these communities and what are kind of the resilience metrics. And I won't go into this in detail because it's a whole separate presentation in and of itself. But just to give you a smattering of things, you know, we really try to take physical resilience, economic vitality, and social well-being at a high level of metrics in that Venn diagram that you see this to your left, to think holistically about what the resilience level is in a community and where might there be some risk. And so what you see at the very top on the right hand is just these 8 metrics that really speak to physical resilience issues. So energy, transit, water, waste, communications, housing, agriculture, and green space. If you are looking to make investments, whether they be commercial, industrial, or residential, leveraging opportunity zones, each of those boxes, there is funding that has now come both through the CRF and the ARP that can be leveraged from the public entity to co-invest with you to address those issues. There's still going to be some costs that you'll bear as a private investor, but there's a lot of costs now that the public is in a better position to actually bear on your behalf with a project that they think is valid and worthwhile that they didn't have a year ago or 2 years ago. So part of the whole process of this project is to just describe to you where that money might exist and how to access it. The bottom or the middle tier where it says jobs, industry, and individual is just another way of assessing where the economic vitality of a community. And the bottom paragraph is around what we'll call social well-being metrics. This is the hardest thing to evaluate and something that in many cases you as a private investor may not want to spend a lot of time around, but there could be some things that you do given the social impact nature of your investment that are meaningful. Identifying and characterizing social well-being is difficult because it's such a subjective measure. But one of the things we've done is to do things like identify block clubs as a determinant that leads to greater civic engagement, church participation as a way to somehow at least make more objective and enhance social network. And by church, I really mean just religious participation in general, neighborhood watch groups in the same way to encourage stronger personal relationships. And so in many instances, the work that I've done with municipalities is to help them kind of create a benchmark around some of these things, and then to evaluate the projects that you might bring to the table that are opportunity zone investments to see where we think your investment will have an impact on any one of these metrics in a positive way. and then use that as a way to determine and to prioritize which private investments the city would like to co-invest alongside. So I share that with you just with some sense of how that might work for your investments. So I'm going to take a quick second here, whoops, and I'm going to take you through this issue that comes up from time to time, which is the opportunity zone legislation is not extended forever, and it could run out. But by history, using new market tax credits and EB5 as an example, it has actually been more effective in terms of putting money to work from the private sector into these underinvested areas than both of those programs. And both of those programs took a lot longer to actually go from being established to being active. And all of those programs have been extended multiple times. So I think the likelihood that this program is extended is very, very high. I'm going to whip through some of these pages just to get to questions because I think we're getting close to the end of the hour. Most of the investments that have been done in 2019 and 2020 have been in Class A office space and hotel. A lot of that is changing because Class A office space has been decimated. Multifamily and residential, I think, will continue and probably even stronger coming out of the recession. And there may be some opportunities around commercial in unique situations, but there's been a lot of busted deals and a lot of stuff that people have put on hold until they have a better sense of where the economy is going. But there is an opportunity also in industrial, given what I described to you of some of the globalization retreat. And a bigger opportunity is around operating investments. The early investments that were done in 2018 were really around investment-ready projects that were already going to happen with or without opportunity zones. They were already in the areas that were easiest to develop, and they were just swapping one capital stack for the next. But we've migrated now into concept-ready projects. A lot of the work I've done in municipalities is thinking about broader concepts, and that's really driving a lot of the public investment that I think will start to lead before the private investment comes. We're moving into this space this year, and especially coming out of the pandemic, where people are looking to make a combined investment that has both a real estate aspect for OZ and an operating investment for OZ, where they can take advantage of both of the benefits that are important. The difference in terms of putting the money to work, the timing, the tax deferral, but also the upsell where, you know, after 10 years of investment, you pay no capital gains on the gains of that business, right? Everybody's looking for the next, whatever it is, TikTok, you know, I guess now it's a cannabis stock or it's a Digicoin or whatever it is. I'll just reiterate really quickly, you can stack all of these things. None of them are mutually exclusive. So opportunity zone, hub zone, enterprise, foreign trade, CRA, TIF, all of these things can be stacked. And there are things that you can ask for, some of which are, as I said, off balance sheet, land, demolition, mitigation funding, CDBG vouchers, as of right permitting, fee waiving, and other aspects of this. I'm not going to go through this page just to make sure we have time. I will reiterate that not only do you have the benefit of opportunity zones, but as you're making operating investments, for those of you who are looking to make social impact investments using opportunity zone money for operating, there's also 1202 small business stock that you can leverage in addition to opportunity zone. And that's been a lot of where the focus has been, of trying to figure out how you go from just single asset projects, that one-off project, to master planned areas, those concepts. But don't forget that there is neighborhood scale investments. And so for some of you who are in the impact investment world, you know, a $500,000 investment on the corner of a neighborhood that takes a church and allows them to build a daycare center next door actually is a very tangible investment in that community. It may not be a lot of money, but it could be a really important investment as part of a broader portfolio of how you demonstrate to a city that your kind of investing is having the kind of social impact that you'd want to have. I'm going to jump real quick. This is just an overview of various types of investment strategies that we have promoted and evaluated that go from specifically to hospitality, leveraging OZ and national franchises, looking at medical districts, also looking at things like housing, vertical farming, and the like. And I'm going to just focus you on these two things to end because we're about 10 minutes, 12 minutes away from the end of the hour. This is one of the largest opportunity zone projects in the country, 19 square miles. It's kind of centered with a 100-acre mall that is right in the middle of this space that's here. The mall is right here. It's bought by a private developer out of New York. I've been working with both the public and the private entity. They've got the University of South Florida. They've got 3 hospitals here, plus Busch Gardens. And all of that area, we're actually redeveloping as part of an opportunity zone. And so it provides multiple different types of investments, operating investments, real estate investments, some of them being hotel development, some of them being housing development, some of them are commercial development in nature. And that's kind of the way that cities are now moving into this OZ space that provides you multiple places where you can invest. Likewise, in New Orleans, this is New Orleans East. It's another project I'm working on. This was all washed away with Katrina. The federal government has helped to rebuild this park, but there's an existing hospital that's here. This is I-10, and there's opportunity to redevelop this whole area as part of an OZ investment, about 17 acres of work. So I went through this quickly, but I wanted to just give you kind of a cursory look at everything, and I'll stop here for some questions.
Thank you very much, Beau. That's a great and very, very in-depth presentation. So definitely want to give audience members a chance to ask questions they have. And I will say to the participants in the webinar, 2 quick housekeeping things. The first is, if you have a question, please click on the Q&A button, which is towards the lower right of the screen, and that will allow you to post a question for the audience to see, and then hopefully get a response back from the panelists. The other quick housekeeping thing for everyone to understand is that once this seminar concludes, you'll get an email with a survey just to get a sense of how you thought this webinar was conducted, and any recommendations you have for webinars in the future, because we always try to optimize what we offer up to our members and make sure that we're addressing the issues that you all care the most about. So with that, I'm going to actually take the liberty of asking a couple of questions initially just to kick off the Q&A. And I guess perhaps the most timely question that I would want to pose to Charles and to Beau is, given the proposed changes to America's tax laws, particularly around capital gains, is there anything that investors, advisors, or professionals should be aware of, recognizing that the law isn't set, and I'm sure there's going to be lots of debate about where the tax law ends up, but given what you are hearing so far, is there anything that people need to be mindful of with respect to their own planning for opportunity zone-based investing?
I think yes is the answer in short. What's going to actually happen is still undetermined, but obviously if there's a substantial increase in the capital gains, as is expected, I think it's going to substantially change how a number of people are thinking about this as an opportunity. The timing of when that change occurs is important, and I'm unsure of that. I think there's a high likelihood that it will happen so the federal government's fiscal year is the end of September 30th. Typically, if they're going to use reconciliation for the purpose of passing the new proposed act that the president talked about, it will happen prior to the end of the fiscal year. And implementation would probably start the beginning of 2022. If that were the case, I think there's probably a big push the second half of this year, especially now that markets are opening up and people are going back to work, to make some investments and put them to work. I actually think there's a chance that in 2022, the benefit OZ becomes even stronger, just because the capital gains tax becomes larger now, right? So there's a greater incentive for people to defer the timing of paying that tax. And there's a greater incentive for you to, if you're going to make an operating investment in particular, to make that investment within an opportunity zone and take advantage of the fact that you still get to write up your basis. Technically, it's not a write-off. It's really, you step up your basis to whatever the market is after 10 years, but it's effectively not paying tax on your gain. So I think that the impacts are likely to be positive, but there could be a variety of things that will change given the nature of the final legislation. I don't know if Charles, if you had any additional thoughts.
No, I'm a more simple guy on this. I think that if the capital gains increase for Americans, the opportunity zone opportunity will only be more valuable. we found that major organizations and institutions do not look at opportunity zones as real strategic part of their strategy. Beau and I, we've had some conversations with major monies to the banks, and we were shocked to find that they weren't using opportunity zones in places where they were using tax credits, and it took more work to do that. So I assume that as more people become aware of the tax benefits and they realize it's a lot easier to manage, it's going to increase its interest as you raise taxes outside of the opportunity zone. The question I do have for Beau is on the same subject. There are many defects as a private citizen that I would look at as regards to what's going on in opportunity zones. First, the marketing is deceptive in that there's this conversation around how these opportunity zones are supposed to positively impact the community. There's no guarantee of that. And in fact, it does not speak at all to the human people there. It speaks to the property. So there are probably some politicians who are seeking to make some changes there. Are you having any sense or awareness that anyone's gotten into the depths and the guts of this thing to try to bring some what you call social standards to the Capitol?
Yeah, there's a lot of movement at foot. Senator Wyden has proposed a bill. Senator Booker has proposed a bill. There are a few bills that are already been proposed. Most of those bills, so I would say this smartly, I think Congress recognizes that there have been very few, there are a number of other place-based investment strategies that have existed throughout time. So opportunity zones is not unique in that regard. Where it is unique is that most of those place-based investments were designated areas within a census tract, but they weren't all one whole census tract. The benefit of the census tract is there's a lot of information that's collected at the federal, state, and county level around census tract information to better evaluate this process. It's obviously going to take a number of years to get there. But I think there's an understanding too that none of the place-based investments have actually resulted in more money being invested in these communities than opportunity zones have done so far, right? So the issue is, I don't want to stop the investment. I just want to make sure that the investment is focused on social impact in addition. And so most of the legislation is around greater transparency of the nature of the investment and the expectation around the social impact. What you are seeing is that cities are starting to become smarter and more deliberate about where they will support a transaction if and only if it has the kind of social impact and demonstrates the kind of social equity that they value themselves. And so a lot of the work that I was describing and what I've done has been focused around presenting to a city or the city presenting to the private sector, these are the wants that we have around the social equity so that we can make sure that we stay true to the nature of what opportunity zones were supposed to be. But the legislation that's been proposed mostly has to do with public documentation around the nature of the investment itself, but doesn't change a lot of the other core aspects of this.
Thank you for that, Beau. There's a question I wanted to pose from the audience. Stephen, who's one of the participants, asked if there are any specific recommendations that either of you have to SBA bankers, Small Businessmen Association bankers, and how they can help small businesses get access to funding in the context of both the rescue plan legislation as well as opportunity zones.
So he is a banker himself, and he's trying to figure out how to be more active in the opportunity zone space. Just to clarify the question a little bit.
Let's go with that. And Stephen, if you have any further specifications around your questions, feel free to post it. But Beau, why don't you run with that response? Since
wait, I think it says, can you give us a recommendation for SBA bankers is the question as I saw.
Is that the way? So if it's, can we recommend SBA
you got
bankers?
it, Charles. Yes, that's it.
I don't have a good list of SBA bankers. And to be honest, this is an area that has always been a struggle for small businesses in leveraging SBA bankers. I actually have multiple hats. So in addition to my work with the Southland Development Authority, I also work with a company, Fluent, where we're doing the work with municipalities that I described. But the good news is there is a substantial movement afloat. So in addition to all of the work that I described around CRF and ARP, which are both the federal funding sources, which have trickled down to the states in terms of their programs, there's also been some major changes to the Community Reinvestment Act, which has spurred just general commercial banks to think differently about the CRA requirements they have at the Federal Reserve level. And so there's been a greater level of interest in impact investing from a banking perspective. A lot of the work for the ARP has really been focused on CDFIs and minority lending institutions and some of the smaller banks, many of whom are more likely to be SBA related lenders than some of the larger commercial banks. Although most of the commercial banks also have an SBA arm as well, but a lot of them do it just for regulatory components, but don't put a lot of investment in it. So I wish I had a better answer and could say, oh, you should call my friend Bob or Jane, but I don't. I would say that, you know, the SBA side of this has not always been the easiest area. One of the things that we've been doing in the Southland area, which is the suburbs of Chicago, is a lot of mentoring work. And in that process, working directly with CDFIs and banks. And that's helped tremendously. And I'm happy to have an offline conversation, because I know we're getting short on time. So
great. Yeah, I think since we're at the top of the hour, I want to thank all the participants who have joined in to hear this great discussion. Again, very, very timely discussion, very, very in-depth information. If anyone wants to rehear this presentation or review the slides again, this video has been recorded. So please feel free to contact the Impact Capital Forum. We'll share with you the recording, and you can, again, get the benefit of everything that Charles and Beau has shared. On behalf of the Impact Capital Forum, Charles and Beau, thank you very much for spending so much time with us and all of our attendees. And Beau, for you, we wish you a great vacation in Hawaii.
thank you very much. I'm looking forward to it.
Thank you.
Thank you, Charles.
With you,
and
Beau.
thanks. Okay.
Thank
You again, everyone.
Kenneth, Tatiana, thank you.
Take care, everyone. Bye-bye.